Most people think debt becomes dangerous when a country cannot borrow anymore. That is not how it usually happens. The real danger begins much earlier, when a country can still borrow easily, but every new dollar of debt quietly buys less growth, less stability, and less time. That is where America is now. And because the system still looks strong on the surface, most people are reading the moment completely wrong. If you are the kind of person who would rather see the pattern early than panic late, stay close to me here, because what I'm about to walk through is the part almost everybody misses until the market forces them to care. I've spent decades studying debt cycles, market cycles, political cycles, and the rise and decline of countries. What I've learned is that big breakdowns rarely arrive as a single surprise. They build in layers. First the numbers get worse, then the incentives get worse, then the politics get worse. Only after that does the public notice, and by then the choices are already smaller. That is why I do not look at debt the way most people do. I do not just ask how big it is. I ask who has to buy it, who has to service it, what the interest rate is, what the economy is producing, what the politics allow, and what the central bank will be forced to do when the pressure gets too high. Debt is not just an amount, it is a machine. And when you understand the machine, the headlines stop fooling you. A lot of people hear America has too much debt and shrug. They say the United States is rich. They say the dollar is the world's reserve currency. That means it is the main currency the world saves and trades in. They say America is not Argentina, not Greece, not some weak country that ran out of options. And on the surface, that sounds reasonable. The problem is that this view is shallow. What matters is not whether America is special. Of course it is special. What matters is whether the forces that govern debt cycles still apply when a country is special. They do. In fact, reserve currency countries often go deeper into the cycle because they are given more time, more trust, and more rope. That extra rope feels like strength right up until it becomes the thing that tightens around the system. I've seen this pattern in history again and again. In the early years, debt helps. It finances spending, lifts asset prices, and smooths recessions. Then it starts growing faster than income. Then interest costs start compounding. Compounding means the growth feeds on itself. Then the borrower needs lower rates, more buyers, and more trust just to keep the machine running. At that point, debt is no longer helping the system breathe. It is sitting on its chest. The first sign I watch is very simple. Interest costs are no longer a side issue. They are becoming one of the main forces driving the whole budget. In fiscal year 2025, net interest on the federal debt was around $970 billion. That is close to $1 trillion just to service past borrowing. In plain English, America is now spending almost $1 trillion a year not to build bridges, not to educate children, not to defend the country, but simply to pay for money already spent. That number matters even more when you compare it to everything around it. It is larger than many major government programs. It has already moved above defense spending on some measures. It keeps rising because the debt stock is larger and because rates are higher than they were when money was nearly free. When people tell me this is manageable, I ask them a very basic question. Manageable compared with what? The United States takes in about $5 trillion a year in revenue and spends about $7 trillion. That means the gap is roughly $2 trillion. Part of that gap is now interest. So before the country argues about new promises, new programs, or new tax cuts, it is already digging a hole. That is not a moral statement. It is arithmetic. And arithmetic becomes destiny when politics refuses to deal with it. I like to use a simple image for this. Debt service is like plaque building up in an artery. At first, you don't feel it. You can still walk, still work, still tell yourself you're fine, but the blockage is growing while life feels normal. Then one day, the flow gets tight enough that a small shock does what years of denial could not. That is why I do not wait for a visible crisis before I say the condition is serious. If your own plan for saving and investing assumes that government debt can expand forever without changing the rules of the game, I would pause, right there and examine that assumption very carefully. The second sign is even more important, and most people do not look at it. The government is moving closer to the point where it must borrow not just to fund normal spending, but to service the debt itself. When I use the phrase debt death spiral, I'm describing a phase where the debtor needs new borrowing to pay old borrowing, and the market starts to notice. Once the market notices, lenders become more cautious. That is when the math stops being quiet. Now, I want to be precise here. America is not at the final stage of that spiral, but it is close enough that the pattern is visible. With debt held by the public around $29 to $31 trillion in recent data, and gross federal debt moving past the mid-30 trillion range and now approaching 39 trillion, the stock is so large that even modest rates create massive interest bills. When rates rose after 2022, people acted like it was only a short-term policy issue. It was not. It changed the carrying cost of the entire system. This is what many people miss. A debt problem is not only about the amount of debt. It is about the relationship between debt and income. A household with a large mortgage can survive if income grows faster than expenses and the rate is low. A household with the same mortgage gets trapped if income stalls and the rate resets higher. Countries are not households in every way, but this part is the same. Carrying cost matters, and carrying cost is getting worse at the exact moment the country has less room to maneuver. Social Security spending is rising. Medicare spending is rising. Defense will not stay cheap in a more dangerous world. The political appetite for real cuts is weak. The appetite for higher taxes is also weak. So the easy answer becomes more borrowing. That is how a long-term debt cycle deepens. Not through one reckless act, but through 1,000 not now decisions. The third sign is the one professionals watch very closely. The amount of debt that has to be sold is becoming too large relative to the natural demand for it. This is where the story moves from the budget page to the bond market. The bond market is where governments borrow. If the Treasury has to keep selling huge amounts of debt and buyers do not show up in the same size, one of two things usually happens. Yields rise sharply, or the central bank steps in more than it wants to. Yields are the return investors' demand for holding bonds. When yields rise, the government pays more to borrow. That makes the deficit worse, which means even more borrowing later. You can see how the machine starts feeding itself. This is why supply and demand in the Treasury market matter so much. It is not a sideshow. It is the center of the whole story. Foreign investors still hold roughly a third of publicly held U.S. debt, and the total foreign pile is around $9 trillion. Japan remains the largest foreign holder at around $1.2 trillion. China is much lower than it once was, around $700 billion. I don't focus on those numbers because I think foreigners are about to dump everything tomorrow. I focus on them because they show the margin is changing. The world is not obviously eager to absorb unlimited new U.S. debt at old prices forever. This is where institutional behavior gives the game away. In 2025, the Federal Reserve slowed the runoff of its balance sheet. That means it reduced the speed at which its bond holdings were shrinking. The monthly cap for Treasury runoff was cut from $25 billion to $5 billion. People can dress that up in technical language, but the deeper message is simple. When the system gets tight enough, even a central bank that wants to step back has to move carefully because the market is more fragile than it looks. That kind of move matters because it tells me the machine is already sensitive. The Fed still had a balance sheet around $6.7 trillion in March 2025, with over $4.2 trillion in Treasury securities. Even after a long period of tightening, it remained deeply inside the system. That is not normal in a healthy, self-sustaining debt market. It is a sign that the patient can walk, but only with support close by. If you want me to keep looking beneath the headlines instead of reacting to them, keep following this line of thought with me, because the biggest risks in markets are almost always the ones that still sound abstract. The fourth sign is that reserve currency privilege is starting to be misunderstood as immunity. The dollar still sits at the center of the global financial system. That is real. It is powerful. It gives the United States more flexibility than any other country, but it does not remove the laws of debt cycles. It only delays their enforcement, and delay can be dangerous because it makes bad habits look sustainable. A reserve currency is like a reputation bank built over generations. People trust it because the rule of law is strong, markets are deep, the military is powerful, and there are few alternatives at the same scale. But that trust gets drawn down when debt grows faster than productivity, when money is printed to absorb excess borrowing, when sanctions push countries to seek alternatives, and when political conflict makes long-term discipline look impossible. The account is large, but it is not infinite. I watched a version of this logic play out with the British pound in the last century. Britain did not wake up one morning and lose reserve currency status in a single dramatic scene. It happened over time as debt burdens, war costs, relative power shifts, and confidence changes gradually altered the world's choices. That is usually how these transitions work. First, the privilege is questioned at the edges, then more people hedge. Then the old center still matters, but it matters less. That is one reason I pay attention to what central banks do, not just what they say. In recent years, many central banks have been buying gold aggressively. Gold does not depend on anyone else's promise to pay. When official institutions slowly increase gold and slowly diversify trade and reserves, they are not predicting the end of the dollar tomorrow. They are reducing dependence at the margin. And in systems like this, the margin is where the future shows up first. People often hear that and jump to an extreme. They assume I'm saying the dollar is finished, America is finished, and collapses tomorrow. I'm not saying that. I'm saying the direction matters, the structure matters, the trend matters. When debt keeps rising and trust has to do more work each year to hold the system together, the odds shift. And smart investors pay attention to shifts in odds long before they see certainty. When you hear someone say, the United States can always print money, so debt is not a problem, do you stop and ask what getting paid back in weaker money actually means for your savings? That brings me to the fifth sign, and in some ways it is the most important one of all. The political system is not acting like a country that sees the problem early. It is acting like a country still bargaining with reality. I have said many times that reducing the deficit to around 3% of GDP would go a long way toward making the path healthier. Instead, the United States has been running deficits closer to 6, 7, even 7.5% of GDP, depending on the measure and the moment. That difference sounds technical, but it is enormous. A deficit of 3% of GDP is still a deficit. It is not austerity. It simply means borrowing at a pace that the system is more likely to tolerate without a crisis. But when a country runs much larger deficits during a period that is not a world war and not a depression, it is telling you something very important. It is telling you the imbalance is structural. It lives inside the normal system now. And once the imbalance becomes structural, every shock hits harder. A recession means lower tax revenue and more spending. A war means more borrowing. A financial rescue means larger guarantees and bigger deficits. The country is entering each new challenge already loaded down. That is what makes this stage of the cycle deeper than most people realize. It is not just the debt, it is the lack of clean options. I think this is the right point to address the biggest objection I hear. People tell me America had even more debt relative to GDP after World War II, and it grew its way out of it. That is true on the surface, but it leaves out what made that period different. Back then, the country had a younger population, a stronger industrial edge, less entitlement pressure, faster productivity growth, and a post-war boom ahead of it. The debt had financed a war that ended, not a long stretch of structural imbalance that keeps rolling forward. The United States also had a very different global position then. It was emerging into leadership with huge productive capacity and far less domestic division than it has now. Today, the country is older, promises are larger, Politics are more polarized and rivals are stronger. So when people point to 1946 and say, we handled it before, I say yes, but the engine under the hood is not the same engine. There's another objection that sounds smart but is incomplete. People say the U.S. issues debt in its own currency, so it cannot be forced into default the way a weaker country can. That is mostly right. The United States can print the dollars needed to pay dollar debts. But being paid back in devalued dollars is not the same as being made whole. A formal default is not the only way creditors lose. They can lose through inflation. They can lose through suppressed rates. They can lose through currency weakness over time. I lived through the 1970s. I remember what it feels like when people slowly realize that nominal returns are not real returns. Nominal means the number printed on the statement. Real means what that money can actually buy. If I earn 4% and inflation is 5%, I did not get richer. I got poorer in slow motion. That is one of the oldest ways debt burdens are reduced, not by refusing to pay, but by paying in money that buys less. This is why the debt cycle is not just a government issue. It reaches into the lives of ordinary people, even when nothing dramatic appears on television. A saver who keeps too much in long bonds can lose purchasing power. A worker can get wage increases that feel decent but do not keep up with living costs. A young family can see home prices rise because money is loose, while mortgage rates also stay high because debt supply is heavy. The pressure shows up in strange combinations. I think about the average person who did everything society asked, worked hard, saved steadily, bought the safe fund, trusted the 60-40 portfolio. That just means a mix of 60% stocks and 40% bonds. For decades, that approach made sense because falling rates boosted bond prices and debt levels were easier to carry. But in a deeper debt cycle, some of those old assumptions stop protecting people the way they used to. Safety starts depending on what kind of risk is coming. This is why I spend so much time on cause and effect. Most people stare at outcomes. They stare at inflation, yields, election results, stock market swings. I stare at the machine underneath. If deficits stay too large, more debt must be sold. If more debt must be sold, either buyers absorb it or yields rise. If yields rise too much, the economy weakens and interest expense climbs. If that pressure becomes too painful, the central bank is pulled toward easier money. If easier money is used to absorb excess debt, the currency and purchasing power bear the cost. That is the sequence. If your portfolio only works when inflation stays tame, rates fall, politics stay functional, and foreign demand remains strong, is that a diversified plan or just a very comfortable bet on one version of the world? There is also a geopolitical layer that people underestimate. Debt is never just finance. It is power. A country with a stronger balance sheet has more freedom to fight wars, absorb shocks, fund innovation, and support allies. A country with a weaker balance sheet becomes more constrained, even if it still looks mighty. The Congressional Budget Office has been clear that rising debt can crowd out private investment, lift payments to foreign creditors, and even limit policy choices in a crisis. That is not theory. That is strategic reality. Think about what it means if interest costs keep rising while the world gets more dangerous. A government then has to choose between honoring past promises, funding current security, and investing in future strength. None of those choices are easy. And when every choice is painful, politics gets uglier. Groups fight harder over shrinking room. That social conflict is not separate from the debt cycle. It is part of it. Financial stress and political stress feed each other. I have long said that the big debt cycle does not operate alone. It interacts with internal political conflict, external geopolitical conflict, acts of nature and technology. Right now, America is dealing with all of them at once. That combination makes heavy debt more dangerous, not less. When several forces squeeze the same system at the same time, resilience matters more than optimism. So what happens next? I see three broad paths. The first is the healthiest, and I would call it a beautiful deleveraging. That means the country gets more disciplined before the bond market forces it to. Spending is restrained where it can be. Taxes are raised where they must be. Productivity is improved through better investment, smarter regulation, and more efficient government. The deficit moves closer to 3% of GDP. Growth slows some, but confidence holds. That is the best path because it spreads the pain early and avoids larger pain later. The second path is the usual political path. Adjustment is delayed, deficits stay too large, yields grind higher or remain stubbornly high. Growth softens, the market wobbles, then the response comes late under stress. That often means some mix of easier money, selective fiscal restraint, and inflation that stays a little hotter than policymakers want. It does not look like a cinematic collapse. It looks like years of lower real returns, more unstable policy, and rising frustration. The third path is the hard one. A real bond market shock develops. Auctions weaken more than expected. Buyers demand much higher yields. Asset prices fall because the discount rate rises. The discount rate is the rate markets use to value future cash flows. In plain English, when rates jump, the value of stocks, bonds, real estate, and private assets can all get hit at the same time. Under that pressure, the central bank would likely have to step in more aggressively, and then the fight would shift from default risk to currency risk and inflation risk. I do not know which path will happen or exactly when. No one does. Anyone who tells you otherwise is selling certainty they do not have. But I do know the probabilities are no longer where most people think they are. America is further along in the long-term debt cycle than the public conversation admits. The warning signs are visible in the budget, visible in interest costs, visible in the bond market, visible in reserve behavior, and visible in politics. That does not mean I panic. Panic is not a strategy. It means I diversify. I think in real returns, not just nominal ones. I avoid making my future depend on one policy regime, one inflation outcome, or one asset class. I want balance between assets that do well in growth, assets that do well in inflation, assets that do well in deflation, and assets that do well when confidence in money itself weakens. Resilience beats prediction when the system is under strain. I also pay attention to quality. In a world like this, fragile balance sheets matter more. Businesses that need cheap debt to survive are more exposed. Governments with too many promises are more exposed. Investors who reached for yield without understanding duration are more exposed. Duration is just a fancy word for how sensitive a bond is to changes in rates. The longer the duration, the more it can swing when rates move. In deep debt cycles, that sensitivity can hurt people who thought they were being conservative. And I stay humble. Debt cycles can stretch longer than people think because policymakers have tools, institutions adapt, and reserve currency status buys time, but stretching the cycle is not the same as solving it. In fact, stretching it can make the final adjustment larger if the underlying discipline never arrives. Time is a gift only if you use it to repair the structure. So when I say America is deeper in the debt cycle than most people realize, I am not trying to be dramatic. I am trying to be accurate. I am looking at a country where interest costs are exploding, where borrowing is feeding borrowing, where debt supply is pressuring the bond market, where reserve currency privilege is being leaned on too hard, and where politics still treats arithmetic like a debate instead of a limit. That is the pattern, that is the tension, and that is why I believe this matters so much right now. The country still has enormous strengths. It has wealth, innovation, deep markets, rule of law, and unmatched adaptability. But strength does not cancel cycles. It only changes how long they take and how they express themselves. In the end, debt problems are not really about money first. They are about behavior. They are about whether a society can live within reality before reality imposes its own terms. Markets are very patient for a long time, then they are not. And when that turn comes, the The people who prepared quietly are the ones who keep their freedom. I have watched this enough times to know that the most dangerous phase is not when everybody is afraid. It is when the numbers are already serious, the system still looks normal, and the public keeps mistaking borrowed time for permanent strength. Borrowed money can buy time, but it can never buy a new cycle.